Founders Forum, Episode 7.
Open your mind to a new episode of the Founders Forum, the podcast championing a free economy, sound assets, and blockchain solutions. Each week, your hosts, entrepreneur Cole Snell and economist Bob Murphy, interview pioneers and free thinkers to help you develop into the architect of your future.
Welcome, everyone, to another episode of the Founders Forum. Today, we're going to be talking to Mike Lingle. He's an expert on security tokens, and he's also the founder of Rocket Pro Forma, which is a service that helps business owners get their financial projections in a coherent framework that they can show to investors and others. Let me just read a little bit about his history here from the About Me tab at Rocket Pro Forma. He says, I'm a former software developer, serial entrepreneur, and executive in residence at Babson College. He co-founded SlideRocket.com, a software as a service platform for sales and marketing presentations that was acquired by VMware in 2011. And since then, he's focused on helping both startups and enterprises launch disruptive businesses. He's got experience including fundraising, management, operations, finance, sales, marketing, and product management. He's run several accelerator programs and has mentored a wide range of innovators from startup founders to corporate executives on how to build high-growth companies in many different industries. And I want to just mention that one of the things we get into, part of it is the SVB collapse was happening literally while we were conducting this interview, so we asked him about that. But also, it was a fascinating discussion talking about ways, for example, of using NFTs in order to fund your business. All right, so there's a lot of interesting material here for founders, especially those of you who are interested in blockchain and other newfangled applications. One last thing before we dive into it, just to let you know, I had a family issue. Everything was fine, but that arose in the other room, and I had to leave the room well into the podcast. And so if you're watching the video, you'll see me sort of wave and sign off. Or if you're listening to the audio, you'll just hear that I'm no longer there after a certain point. So that's what happened, just so you're not confused. Without further ado, here is our discussion with Mike Lingle.
So Mike, we're thrilled that you're here today to talk with Dr. Murphy and I. The show is called Founders Forum. You work with a lot of founders. One of my favorite kind of questions to start one of these podcasts off is, what's up with founders? What's happening with founders in 2023? What are you seeing? What are they challenged with? What are they doing right? What are they doing wrong? Are you excited? Are you nervous for them?
I'm always excited. It is not a good day for startups with Silicon Valley Bank self-destructing. I also do a lot of work in the blockchain space, and it's hard to get a bank that's friendly with crypto. So having Silvergate go under, which is the crypto bank, having the rails that Silvergate built go under, which is how a lot of the crypto companies were moving money around in the background. And then having Silicon Valley Bank go out, which is the founder-friendly bank, and is actually slightly friendly to crypto. At Security Token Group, like Silicon Valley Bank actually banked us, even though we have the word token in our name. So it's not the best day for startups, and it's not the best day for blockchain startups today.
Mike, could I ask you, just because for people listening, like we're recording this right as the Silicon Valley story is happening amidst our very, so maybe just for the benefit, or perhaps for like foreign listeners who might not know, just the real basic, can you just explain what, because my phone was blowing up while we were doing, earlier meetings and stuff. Okay. So this is a big deal. Can you just briefly explain for people who don't understand the gravity of the situation?
Sure. And here's what I think happened. So Signature has bet heavily on crypto and does work with a lot of crypto companies. It also created actually unapproved payment rails. It turns out they did not have a disapproval letter, but it was not actually approved by the government regulators. But anyway, they built essentially their version of a SWIFT banking payment system behind the scenes that a lot of the big crypto players were using to move money around in the background. And basically what happened to them seems to be not a crypto-specific problem. It looks like, and I'm not a banker and I'm not a regulator, my understanding is for both Signature and Silicon Valley Bank, a couple things happened at the same time. One is the government has specific requirements about collateral and having, obviously banks are in the business of taking deposits and then using those deposits to generate more revenue. The government has rules around collateralizing your deposits. So both of those banks bought a bunch of collateral in the form of treasuries and other safe instruments at lower interest rates a couple of years ago. That's all fine. They were relatively short duration, a few years. If nothing goes wrong, they just ride it out and then roll into higher interest vehicles. What happened to both of them was their core business dried up. So in the case of Silvergate, they were betting heavy on crypto. It's a crypto bear market. All of a sudden, they're making less money and companies are withdrawing funds. So in order to cover those deposits, they had to dip into this collateral, but it's an expensive time to dip into the collateral because interest rates have shot through the roof. So that created effectively a run on the bank. Similarly, with Silicon Valley Bank, they had to dip into, they did something similar. They bought a bunch of low interest collateral per the government regulations. In their case, the startup market has been slow because the whole economy has been slow. They make a bunch of loans, but they make their money on the IPOs when startups grow and go public. Those IPOs haven't been happening as frequently. So in a similar position, Silicon Valley Bank hasn't been making as much revenue and needed to sell a bunch of collateral at a loss yesterday in order to cover the deposits that they're paying out. And that also created a run on the bank, and the FDIC just stepped in and seized the assets of the bank. So in both cases, I guess we were trying to be responsible about collateralization, but it ended up creating a problem.
What was the loss? It was like $1.5 billion or so, the loss?
Yeah, for Silicon Valley Bank, it was 1.8. And I believe for Silvergate, it was like $1 billion. Silvergate had a much smaller balance sheet, so that billion was a much larger chunk of their balance sheet.
Sometimes what I like to do, because obviously Dr. Murphy is a public figure as well, and I like to ask him questions sometimes, even though he's a co-host and we're here to ask you questions. This is a question for both of you. When I hear stuff like this, and just bear with me as I work through this. When I hear stuff like this, I think of all of my friends that remind me all the time. And there's this big kind of unbanked culture that's quite popular. All my unbanked friends say when these kind of things happening, and Bob, my phone's been blowing up like your phone, but all my unbanked friends are blowing me up saying, see, another Ponzi hits the dust. This is what because their thing is when they talk about Ponzi's, their thing is that banks are the biggest Ponzi's. That's their thing. I'm generalizing. I'm not saying that banks are Ponzi's. I need banks in my business just like anybody else does. But when you're collaterally assigning depositors' funds, fractionally reserving it 10-1, kind of like smells like a Ponzi. If it quacks like a Ponzi, it might be a Ponzi. No? Am I onto something here? Are they onto something here?
Well, I'll jump in. I'm curious, Mike, what your thoughts are too. So yeah, I mean, I'm an Austrian school economist, as we've talked about in previous episodes, Cole, and I'm in the particular what's the Murray Rothbard strain of it when it comes to banking issues. So yes, I'm actually a proponent. And we earlier, Mike, we had Caitlin Long on the podcast too, and she's the founder of Custodia Bank. Yeah. That's her big thing too. I was
reading her tweets about.
Okay, great. Yeah. So yes, there is a tradition, and by the way, this isn't some like crankish Austrian school thing. Like even in the Chicago school, there was a long tradition after the Great Depression. There was a bunch of the Chicago school economists were saying, maybe we should just have banks, like the core banking function, checking demand deposits is 100% reserve, and maybe that would solve some of these problems. And then people debate that stuff. So. Yes, Cole, I would say that, there is this unfortunate tendency that most people think by its very nature, a bank needs to, borrow short and lend long. You can do that as a credit intermediary, so you buy a CD from a bank and that's fine. But then the crucial difference is you can't go spend the CD at the grocery store. You can try to sell it to somebody if they want, transfer the asset, but whereas when you have your money, in the bank, you think that it's there for you and you can go spend it, even though you vaguely are aware you saw It's a Wonderful Life. There could be a run. But my point is, bank runs happen because of the institutional structure and some of the legal rulings, and there is a growing group of people, and now with using crypto and blockchain technology and they are trying to say maybe we can. This is time to build something where people who really want to know that their assets are there, they can't earn a big yield on it, but at least they know it's there. And so that's definitely a strain of thought that every time one of these runs happens, more people say, "Gee, why does this keep happening?"
First of all, if you like the services that the bank provides, i.e., loans, right? The way the business model works is they take in deposits and then loan them out in order to make more money on those loans in order to pay the depositors. But you don't want them to loan out all of the money. So the thing here is like, where is the safe place to put enough of the deposits that you can handle a run on the bank? I am not an economist, so anyone can jump in and interject if I'm missing a piece of this. I'm grossly oversimplifying. What I do think is important to the way I'm looking at this is similar to the way I'm looking at some of the stuff that has blown up in crypto, which I think is an important lesson for any startup. It is really easy to build a system that works in a friendly environment. You have no idea if your system works or not until you get into an unfriendly environment. So if we're looking at this bank collateralization rule that just took out 2 banks in a rising interest rate environment, have we fully road tested this rule, or are we road testing it on the fly here now that the environment's unfriendly? Similarly, Terra, Luna, right? That worked great when conditions were great. It did not survive the stress test. FTX was a freaking disaster. I mean, that was an actual Ponzi scheme, so we can take that one off the table, although it did work in a friendly environment. Although actually, now that they're doing the forensic accounting, it turns out they were losing money in the bull market. So maybe it never worked. So again, we'll take that example off the table. But if you look at the history of startups, a lot of great startups and successful startups were built during recessions, down periods in the economy, I think because they were forced to stress test their system on the fly in bad conditions, and that did much better when the conditions became friendly.
Yeah, I really appreciate what you just said. Yeah, go ahead, Bob.
Well, I was going to say, so Mike, is the possible lesson there then, or silver lining that there may be companies we haven't heard of yet that are going through the birthing process right now, but 5 years from now, people say, "Oh yeah, well they emerged. Remember that bloodbath back when FTX went down and
yes, exactly.
Silvergate and all that's okay."
Yes.
Yeah, there's something commonly referred to as building in the bear, where it's actually there used to be, wasn't there like in malls all around America this thing called Build a Bear? Do you remember the kids going to build? I just thought about this right now. So it's like Build-A-Bear was like that's the right time. It's Build-A-Bear, build in the bear. I mean, this is the right time if you can, again, you're building it as you're flying it, and you're flying it in stormy weathers. When you come through the storm and the plane is built, it's likely going to perform pretty efficiently in calm skies. So to your point, I guess maybe that's where the regulators, maybe they can oversee that. Somehow they could oversee these startups that are raising all of this money and lending all this money and taking you built in a bull market, so you have to scale back by 50%. Maybe that's just all the regulation you need. Forget all of this other really thoughtful, intelligent stuff. It's just that you have like a governor put on your business if you in fact did build in a bull market. Excuse me. I don't know, maybe that's just oversimplifying it, but.
Well, I think that's about. Can I ask you, Mike, because this does tie into the general stuff of what we're talking about, that I want to make sure we're not leaving our listeners behind. People conflate crypto and security tokens and conventional banks. So maybe would you, like from your perspective, just to, like what is the difference between like a cryptocurrency per se versus like a security token?
Sure. And I think there's a fun middle category there too. So
sure, yeah. However you want to slice and dice it.
Sure. Here's how I think about this: a cryptocurrency has no asset. So if I go buy an Ethereum in my MetaMask wallet, right? I am not buying a share of the Ethereum corporation. I am buying a token. I can transact on the Ethereum network, but I don't own anything other than that token. That token has value. It doesn't necessarily have value of an underlying asset, but the network and the fact that the network is used for a lot of different things gives that token value. But there's no asset there. An NFT a one-of-a-kind, whatever, monkey picture or whatever NFT we're going to talk about, that's like a baby security because now we have an asset. So the monkey picture is an asset. Some of those monkey pictures are very expensive to buy, right? So now we have a baby security because I now own something. Again, we can debate the underlying value, but there is an asset there. What a security token does is it takes an actual security, a securitized asset, a share of ownership of something, and it wraps that in a digital token on the blockchain. So now you've stepped into the world of securities. It is definitely a security. And you are now regulated. If you're in the US, you're now regulated by the SEC in order to issue, buy, and sell that tokenized security.
Well, yeah, and so that helps solidify too the taxonomy, if you will, of these different creatures and how we put them into their genus and species and whatnot. But let me, it's partly why we like to stress that too, is because if something like this happens, things crash or whatever, and I think it's important for people to realize, well, if there's a digital asset that's tied to some real world asset, that's a qualitatively different thing from just a cryptocurrency that's like not backed up by anything, if you will. So
right, correct. It doesn't mean you can't make money buying and selling those things. It's just a different animal.
Right, exactly.
Mike, do you feel that security tokens, just to broadly ask the question and maybe kind of just bluntly ask the question, do you think that security tokens are a solution for the problems found in what would be, say, crypto tokens?
I mean, I think at their core, if you think of them as different things, I think at their core, they solve different problems. Ethereum needs a token like a native token that trades on its network in order to function as a blockchain. And we as a society have decided that we need securities, shares of companies or ownership of bonds or ownership of debt, ownership of real estate, ownership of fine art, right? All those are things that are securitized. And we as a society have decided that that's important to us. So that's another use case. I think where things get confusing is there are a lot of people trying to use cryptocurrencies as securities specifically in order to live outside of the securities regulation because it seems easier. So I think that use case is becoming less possible, and we will see a narrowing of that use case due to regulation in the coming months and years.
Going along with that vein, I'm curious as to your thoughts is what do you think? So again, with all of these blow-ups or implosions,
Right.
perhaps is a better term, do you think the industry is cleaning itself up and people are going to learn from that? What regulatory changes you think is going to happen? Because it is weird. Like, I don't. Is it just a thing where people have short memories, or it takes like a new crop of people who were not adults during the last crisis, and then they're the ones that it seems like the same mistakes keep being made over and over. Is what I'm getting at.
I mean, yes, if you allow things to happen unregulated, people will do crazy things. The flip side of that is if you add too much regulation, no one will do anything. So the goal of society is to find whatever middle ground can be found, which is never the right middle ground, but it is a middle ground and people manage to function, right? And what I would say about security tokens, they are great for certain situations. And they have some terrific properties. Like, for example, you can't really steal a security token any more than you can come into my brokerage account and steal shares of Apple Computer, because there is a broker dealer and a transfer agent that will just reissue me my Apple shares because I'm the registered owner, which is very different than someone can come into my MetaMask wallet, steal my Ethereum, steal my NFTs, and there is no recourse. So there are some great things that happen. The flip side of that is that you're entering into a regulated world, right? So the fact that in order to operate in the security token world, right, like if I were to do a crowdfund for my startup, I have to go through, a registered broker dealer or someone who can host that crowdfund who's licensed with the SEC. I have to do whatever the diligence is, right? It could be audited financials if I have operating history. And I've worked with startups who've gone through that process, and it takes months and a lot of work, and there are legal fees, and there's a whole world of stuff that you have to do in order to do that crowdfund. And I seen that work well, and I've also seen it be very expensive and time consuming, and the startup is dying in the background while that's happening, which is different than launching a cryptocurrency or an NFT collection, which can happen much quicker and is not regulated because you're not operating in a regulated market. So you still want to call your lawyers, but that can be an easier and faster route to funding. This is a show about startups. So for startups, I think NFTs in particular offer a wonderful way for startups to both self-fund and to create a community that can help carry those startups along.
So you bring up a really interesting point about funding for startups, and this is obviously a real pain point. The idea of using crowdfunding as an example is a popular way. There's various different platforms by which you can crowdfund. You talked about an exemption, or like what would be Reg CF, which would be an application to the SEC, going through the proper channels. Is it fair to say, and again, just to ask a really kind of blunt question, is it fair to say that a startup that can't work their way through, stomach the regulation tied to Reg CF or an SEC application, the accounting, the audits, the legal, the broker-dealers, the transfer agents, that all of the hoops that they have to jump through, likely doing all the things that founders don't like to do, because founders, generally speaking, are creative people. They're visionaries. They're not people that like to get caught up in the mud of all of the things we're discussing. But could you say that if you can get through those things, it's more likely that you're going to succeed, and that to some degree, it's a filtering process to separate the good startups from the bad startups? This is just not my opinion. No, I'm not trying to push the answer one way or another, but it's kind of a question. Like, is there any merit to it?
I wish it were that easy, but no, I have not seen that filter work. I have seen startups get through the process who do not succeed and are not great business people, but they manage to get through that process. Some of them go on to do successful raises, some of them do not. You can go and talk to anyone who has invested in multiple, pick your crowdfund platform startups, and ask them how many exits they have, and that may be a good answer to your question. I suspect not that many. And there's a hidden cost to those crowdfunds typically, which is you're along for the ride, right? Like if I buy whatever startup, right, they made it through all that diligence, they launched on the crowdfund platform, I invested, I put my $500 in, $1,000 in, there's no liquidity. Like I can't sell those shares. So I'm just holding on to that indefinitely, typically 5 to 7 years, until there's an exit or until the startup goes belly up. So I'm locked in, which again is one of the problems that security tokens are attempting to solve, which is the regulation CF, regulation crowdfund that you mentioned, has a 1-year lockup. But after that, the tokens, the tokenized shares of the company could trade on a platform, and then you can get in and out of that startup. Now, there may not be a market for those shares, as we just discussed, but at least there is a possible liquidity option in the security token world for those shares.
Right. And then so that there's a primary and a secondary market then after the lockup for those, tokens. And so just so the viewer or the listeners or the viewers exactly understand, primary would mean accredited investors, and the secondary market would be retail, say, investors. Wholesale versus retail investors.
It depends on your exemption. So in a regulation CF, which is the crowdfund, the primary purchasers can also be unaccredited. They can be retail.
So there's Reg CF in that case, and then Reg S, which should also be unaccredited but non-American in that case. And then there's Reg D, which would then be accredited, and basically virtually anybody in the world in that case could invest into it. But
correct.
There's an AML KYC process.
Right. Startups who are not doing crowdfunds, whether they know it or not, like if you go raise money from investors or venture capitalists, you're typically raising in a Reg D exemption. You may not call it that. You may not know that. But what that means is you can only sell to accredited investors, and those accredited investors can only sell to accredited investors. So that is designed to protect retail from getting into trouble. And with the crowdfund, there's some experimentation and sort of pushing the envelope into what if we open up some of these offerings of early stage startups to the retail investor in a protected way, and there's some limitations around how that works. But the Reg CF is designed to let the retail investor into deals that were formerly only for accredited investors.
Just on that quick point, Mike, do you know, and if you don't, that's fine, but weren't there recently hearings looking into, I don't know, some of the Republicans were looking into trying to relax? Because I know they had like a bunch of small business owners come in and testify and say it's not fair that, you know, my clientele can't invest in my business.
Right.
Like only the fat cats can. Is that on your radar?
I think they were actually looking at raising the requirements in order to protect investors better in their view. So I haven't heard of anyone looking to relax. I haven't heard of any government agencies looking to relax the requirements, but I think there was some discussion of tightening them.
Okay. Well, that would be bad from my point of view, but yes. So the logic being, so right. I mean, just for the listeners, they get the issue that, yeah, they're like, oh, you got to have a certain amount of money. But then the flip side is, and this is the arguments that I know at least some of these witnesses were making on this committee. So it was a committee that was like in the last month, but I don't remember off the top of my head. But they were making the point that, okay, but there's like a sort of, you know, old boys network where
correct,
all the rich people are allowed access to these potentially lucrative investments. But you rubes out there, you know, this isn't for you. When you know, with it, so that's. And it seems kind of, you're protecting us by not letting invest in the things that you want to invest in. Okay.
Which, I mean, it's the same with Bitcoin. So like the SEC has refused to allow a Bitcoin ETF that actually points to spot Bitcoin. Meanwhile, Bitcoin was the single best performing asset for 10 years when they were refusing that. Like in the past two, it's dipped, but you know, it's hard to say who's protecting who from what. Or we started this conversation with, we've just had two banks go under basically because of federal requirements about collateral designed to protect the banks, right? So I don't know.
Yeah,
I don't know who's effectively protecting who here.
Bitcoin ETFs, for example. So I mean, it's widely understood for people that follow political news that Canada is gone from one of the great countries to live in very quickly to one of the worst countries, because of basically government and leadership and various other
Not
things.
because of the Bitcoin ETF?
However, no, they do have a spot Bitcoin ETF.
Yes.
That Canadians, they do have a spot Bitcoin ETF. And for listeners, I think that the ticker on what would be the Canadian exchange called the TSX, the Toronto Stock Exchange, I think the ticker for it is QBTC.U. And Canadians can buy it in what would be like the equivalent of an American product, which is like a Roth product, which is a full tax-free savings account called the TFSA. So you actually a Canadian can buy spot Bitcoin in an ETF in a highly regulated exchange inside of a tax-free vehicle, which is about as, in my opinion, cool of a retail investment as one could get. So go Canada.
Yes.
Yeah,
I'm sure Justin Trudeau is working to shut that down as we speak. But
as we speak,
I think those products also obviously are not doing well in the bear market.
No.
Yeah, a lot of that stuff, unfortunately, because obviously, I don't know, I like the blockchain and I want to see that stuff doing well. But it sounds like some of those products are being restructured or wound down. I know here in the US, you know, some of the Bitcoin ETFs have hit some rough waters.
Mike, can I circle back? You mentioned something about 10 minutes ago about how a startup may use NFTs as a way to raise funding. Is that what did I catch that?
Yeah. And I love that. I think that is the way to do things right now. It requires a community. Like you need hundreds or thousands of people to show up and buy your NFT.
Can you just clarify? Because I think for a lot of people, they're picturing like what? So like, I can see how an artist, you know, a guy who does comic book sketches, that makes sense to me. If you need, are there other use cases that's not as obvious that, oh yeah, you could use an NFT for that?
Yes. So I think what NFTs are doing, you know, we're in the bear market, but what's happening to NFTs, there's a whole strand of art, right? So yes. And NFTs have an appearance. So even for the non-art NFTs, the appearance can be important. But what's happening with NFTs is they are becoming membership cards, essentially. So if we look at Starbucks, which is launching an NFT program into their membership app, they're calling them stamps, but really they're NFTs, and you can buy and sell them on NFT marketplaces. And they just dropped a bunch yesterday, and they went 5 to 15x in price in a day. Those unlock actual experiences and additional benefits as a member. So it's a way to supercharge and boost and establish membership with a community. And I think that's the real use case, regardless of what the art looks like.
Interesting that, so there was a speculative value put on top of the intrinsic value of the NFT. So Starbucks dropped their NFT yesterday, or their stamp, at a NAV of, say, $1.
It was $100,
and then it
about
$100, and then it 10x or 15x because of sentimental interest.
The floor is now 500, and then the expensive ones are going for 1,500 plus.
Wow. I mean, so there's people now. So then you're saying that if you were a startup, just to back to Bob's line of thinking, because I really like it. If you're a startup and you wanted to raise money, and you could generate that same sentiment for your NFT or your stamp, then you would have instantly raised, if the NAV was $500 and you went 10x or 15x, that spread would be the money you have then to build your business, operate your business.
Well, we're back to primary and secondary. So the primary offering of Starbucks was at $100. That money goes to Starbucks. So if I sell 1,000 stamps at $100 a piece, that's $100,000 that's coming into my treasury. The secondary, when it's selling for 500, I'm typically taking whatever 5 to 10% of that of each transaction, right? So for every $500 transaction, maybe I'm taking $20 to $50 of that transaction. So if there's no trading, I'm not making any secondary money. But if there's a lot of trading, $25 a trade can add up pretty quickly to daily income on top of the primary that I put into my bank account. And I would add, for most startups, this forces them to build and maintain great relationships with the community, which startups have to do that anyway, right? So it gets you into the business of being in business, because now you have a responsibility to these people who are buying, holding, trading your NFT. So one powerful approach that I've seen with SaaS software, for example, they can drop an NFT collection that gives you lifetime access to the capabilities of the software. So that becomes like the Genesis or the OG membership. And then for people, and those trade, but that sort of funds the development. And then they sell subscriptions additionally to the people who don't have the NFT. So you've got this super group of people who always have access, but they can buy and sell that access. But then other people can just come in and buy a subscription like you would normally buy a subscription.
Mike, I'm puzzled. Maybe I'll use the word puzzle. It's fine. Can you just explain a little bit again, because this some terminology is new to people. So NFT, non-fungible token,
right?
And I get it that you've got some piece of art that's hanging, on someone's wall, and then someone's issuing a digital token that's like a claim to that or represents it in some sense, and it's non-fungible because it's that piece of art is the piece of art. It's not that it's shares of stock or something that's interchangeable or homogeneous. But I'm getting a little hung up there. So your example was fascinating. I'm glad we asked you to elaborate on this stuff. Yeah. But in terms of subscriptions, so I have a bunch of computer code is what my company develops, like subroutines and modules and things. And then I'm selling a token that gives you the right to peruse those. Is that?
Yeah. So, let's just take Netflix as an example, right?
Okay.
I come to the Netflix website, whether I do it through a browser or through the Netflix app, I'm connecting to the Netflix servers, right?
Mm-hmm.
The way right now that Netflix validates my subscription is I have a username and a password. So most of the time I don't have to enter that username and password. Netflix just remembers my device. Right. So I don't really think about it, but I show up and they bill my credit card once a month or once a year, right? They know they have the money. I have a user account. They validate that account by the username and the password. I validate that user account by the name and the password. All good. If I stop paying, they don't let me in. As an additional feature, if Netscape were to drop, let's say, 1,000 membership cards, and I happen to have one of those membership cards, I can show up to the Netflix site and link my crypto wallet. And there is an additional feature. So yes, there's a piece of art and it's a one-of-a-kind piece of art. It doesn't have to be one-of-a-kind. All the membership cards could look the same, right? But yes, there's a piece of art. But the other thing that an NFT gives you is the ability to validate that you own the original. So if I show up to the Netflix website, I connect my crypto wallet, and that wallet is holding the verified original of one of those cards. That could also let me into the site without a username, without a password, without a credit card charge, because Netflix has decided to allow that entry. And then I'm watching streaming
You're
videos.
watching Squid Games. Right.
Right.
So to maybe say it a different way, I guess the question would be, I think Netflix is a good idea. So you decide, okay, I'd like to watch Netflix. I'd like to be a customer of Netflix. I could purchase this NFT as an entry point, or I could purchase a traditional subscription by accessing the app or a browser, username and password model. If I decide for the NFT model, then can I then take that NFTs, like unlike if I have a subscription, I can't take that subscription and go and trade that subscription at all really in a secondary market. I can't say, okay, I'm done with this. I've put X number of dollars into it. I'd like to go and cash out. You can't do that, really. You basically surrender access and Netflix takes your money and you're left with an experience, essentially. Whereas if you have the NFT, then you could actually take that NFT after you're done having the experience and then trade that in a secondary market.
Correct. Like I can sell my Netflix membership card to you and you can take it and run with it.
Right. And is Netflix obviously is happy with this? So if we're using Netflix as an example, so the business owner or the founder, the person watching this podcast today is Netflix. How does that benefit Netflix?
So we've just watched Starbucks do this, right? To pick a brand that we're all familiar with, right? So Starbucks just made a bunch of money. I mean, not enough money that it's a blip on the full corporate radar, but enough money that it's like a reasonable experiment, right? So they got money from the initial $100 sale, and now they have recurring revenue from the transactions that are happening as people buy and sell these membership cards. And what they're testing now is how rabid does that make the fans, right? Because they're offering additional experiences for the high value stamps. So I can build as a Starbucks customer, I can get one of these stamps and I can build it into a high value stamp by going in, buying coffees, getting reward points, putting those reward points into the stamp. So, and then I can turn around and sell that stamp for money or use that stamp to get unlock whatever the experience is that Starbucks is offering me or additional rewards points or whatever. So we are in the opening innings of Starbucks trying to understand what does that mean for our membership, right? This is a whole new thing. And it is not an ICO, so it's not nonsense. And it's not security token, so it's not in a regulated market. So,
and it's not an IPO.
It's not an IPO. And at the moment, it's an amazing way. So let's take Starbucks off the table for a second. I'm doing whatever startup I'm doing, right? And I would normally do a Kickstarter or a WeFunder, or I would go pitch VCs. Now I have this additional option of like, I'm going to drop this. It could be art, but it's likely membership into the community. I'm going to create the community, and that's going to build, create a nucleus that the community can rally around. I can do some other cool Web3 stuff on top about it to get the input of the community even more into my business. We'll talk about that in a minute. But I've now created something new. I've pulled people in. I've got people excited, and I've got money in my bank account to grow the business that I didn't have before.
Right. I have one more question. Can I ask you, Mike? Oh, yeah. Go ahead, Bob.
Can I go?
Go ahead.
Okay. All right.
Yes, please.
Maybe we should have an NFT that gives us the right to ask the first question.
Bob and I do this when we're excited, so you can take this as a
right. I know. That's right.
Yeah.
We should have like a bidding thing, and then whoever's willing to pay most gets the floor. So I'm an economist. That's how I think. So, but I'm trying to understand because I'm seeing all the are you saying 5 years from now, like airline frequent flyer miles and things like that? Are you saying NFTs are going to be the way that or I know like it's a big thing, subscriptions, like car washes and stuff. Like there's a model sweeping that industry where they say, look, just sell your car. They pay you a certain amount per month. such that if somebody went every week and got their car washed, it'd be cheaper, but you end up making way more money because in practice, people don't actually go that much. And even, you know what I mean? Even though they think they're saving money, that kind of stuff. And your marginal costs are so low anyway, even if they did, who cares? So are you saying that the NFT is what's going to sweep all of that kind of stuff in terms of as those companies want to get on the blockchain? Or does it really need to be, no, there's got to be something more, otherwise you would use a different route, like the community aspect. Like people aren't going to the car wash to hang out with other people whose cars are dirty.
Yeah, there's no community around the car wash. And we'll see about Starbucks. I don't know how big a community there is between the members. So we're still in the early innings of figuring this out. I don't love making blanket statements about everyone should do this. And I don't know today if going onto a blockchain is the right solution for a car wash membership, right?
What can I ask you? But my question though is, if they did want to do it, are you saying, oh, then NFT is the architecture they would use?
Do it with an NFT, yeah.
Okay, that was my question.
Correct.
If they did, then it's because I think most people are just picturing NFTs are about artwork. But when you were saying, well, yeah, but if it's like the picture of your membership card, and that's, and it's non-fungible because it's got your name on it or your ID number.
Because you can validate on the blockchain that that's the actual membership card.
Right.
It doesn't matter. Like if you take a picture of my membership card, you don't have my membership card. You just have a picture of my membership card. Whereas I have the actual blockchain token, and I can show up at the wallet and whatever website can look at it and say, oh yeah, that's the actual one. Like that's the thing I think people are missing. It's not just the monkey JPEG.
Yeah.
It's the ability to validate that is the monkey JPEG.
And that's why it's non-fungible, right? That's the whole point. Because the photos, the JPEG files are all literally identical, but the non-fungibility means, no, this was the original, even though you can copy the zeros and ones.
Correct.
Yeah.
Correct.
Right. From a unique piece of code that's embedded into the NFT and then sitting on top the blockchain, which is a ledger that proves the entire thing. So I want to go back a little bit on the Netflix to the Starbucks. So we have the NFT, Netflix or Starbucks. It's being traded in the secondary market. The line of thinking that I want to kind of continue to go down is, how does Netflix or Starbucks continue to make money versus just selling subscriptions? We get the value of the community. The value of the community is huge. I mean, this will naturally create a community. People in businesses go out and spend massive amounts of money, time, and energy trying to create communities on social media, for example. You could argue that one of the biggest benefits of this NFT play is the community. It could be even more important than the actual fundraising mechanism of it. So you and I, say, are both customers of Netflix or Starbucks, whatever example you want to use. I have the NFT. I'm done watching Netflix or using Starbucks. I have the NFT. You're interested in one. We go into a marketplace, in a secondary marketplace. Now we're peer-to-peer. You don't own Netflix. I don't own Netflix. I have something you want. I put it into the marketplace. You say, okay, I'm going to buy that from you. Now, that's an exchange in the secondary market between you and I, peer-to-peer. And it's kind of governed by, again, the code in the blockchain. Now, the question is, how does Netflix, in this case, or Starbucks, make money on you and I transacting back and forth in a secondary market?
They're taking a commission. The way the NFT market works is they get a commission on every secondary trade, which is very different than the way the stock market works, right? Like Apple's not getting a piece. Like if I sell you my shares of Apple, Apple's not getting a piece of that. But if I sell you my NFT, the maker of the NFT gets a cut of that transaction.
And so just understand that's exactly, and so this is where I wanted to kind of like bring this full circle, is then that is embedded, there's code embedded into the NFT that would guarantee that every time it's transacted, a certain piece of that value of that transaction, a percentage of it, would then go back to Starbucks or Netflix in this case.
Yeah, although we've actually learned it's not encoded into the NFT. It was a gentleman's agreement that some of the marketplaces are now reevaluating their willingness to do, and there's a big battle brewing over those commissions. But for the sake of argument, let's assume that those commissions will continue to get paid in many instances.
Right. Okay, good. So I just wanted to kind of, because I think, so if a viewer is thinking, well, how can I raise money with these NFT moving forward? It's kind of like, passive income, so to speak, residual income. It's another income stream as well for the business outside of the day-to-day. Once you've minted and set these NFTs into circulation in the secondary market, then is it fair to say that then there's a passive income stream essentially from the transaction in a secondary market of these NFTs amongst the community?
Correct.
Which is a pretty massive advantage for businesses.
I believe so. I also believe there's a place for raising money through NFTs and or crowdfunding where you have sort of the nameless, faceless crowd, at least at first. I still want to have a conversation about community in a second.
All right.
I think for many startups, similar to like a successful Kickstarter, it's also a validation signal that you can then take to investors and get some real investors into the company as well. Not necessarily only for the money, but also to get someone involved in the company to grow and exit other startups. So, I was part of a venture-backed startup for a while, and the VC partner who we got on our board of directors was at least as valuable as the $2 million we raised in our Series A. And I think that's often overlooked in the startup world, is how valuable the right investors can be.
I agree so much. There's a startup I'm involved with right now, and there was an investor in a Series A that was questioning, like they often do, our valuation. And my easiest answer to the question about valuation is teams. Look at the team. If you can't see the value of the team, the people that are, whether they're on the board or they're contributing, then that is such a massive mechanism of measurement for valuation, in my opinion, especially for startups. So, I think the advice is don't be afraid to go out and, I'll use Bob, for example. Bob is somebody that I wanted to work with, closely. Right. I wanted Bob on my team, and, I was relentless about showing Bob the value in what it is that we were doing. So, people say, well, Cole, how do you rationalize your valuation? And I go, Dr. Murphy works here,
right.
What else, where do you need?
Right.
And generally people go, that makes a lot of sense. I get it.
Yeah.
He doesn't just work here. He's a partner here as well. He's, this, so just wanted to throw that out there as a real kind of tangible nugget. If you think you've got something valuable, be absolutely relentless in putting time and energy into the team or the board, and do not underestimate the value of your team.
Yeah, and it's not even about the money. Money is important, but really the people that you're able to assemble, including getting great investors who really add value beyond the money, is what I've seen to be very key to startup success. The nice thing about Web3, which I like a little bit better than the crowdfund, is there's now a place for people to hang out, right? Which typically is a Discord, but could be anywhere. And what you see in these Discords for these NFT projects is you have the public, so everyone can come hang out, and then you have a gated room or series of rooms for people who hold one room. If I hold 10 of the NFTs, I can get into like the super special VIP, right? So it's cool because like you show up and you're like, oh, I want to be in the super special room. I should buy some NFTs, right? You have that sort of social pressure. But really what this does is it's a congregation place to get your community on board, right? And so then now it's the dream of every company, right? It's not just me as a founder connecting with the community, it's the community connecting with the community. And the more I can facilitate that, the stronger my brand gets in the world. And then I can start to use the crowd to help me build my business. There are some decisions that the crowd should never make, right? Like we've seen, I'm going to introduce a word that we haven't said yet, which is DAO, Decentralized Autonomous Organization.
I was literally just going to say the exact same thing. I love it. We're so on the same page.
Right.
Yeah.
So basically what it is it's a governing body of this community related to a blockchain project. So you see it a lot in the NFT world. The problem is if you give them full decision-making authority, the crowd is actually terrible at making decisions about. We saw like very successful DAOs get wound down because one member called a vote to dissolve the DAO and no one else showed up to vote, and like they just won the vote, right? But so you don't want to necessarily give the DAO all of the control, but I think what you do want to do is give the DAO control over decisions that crowds make very well. And I think if we think about our businesses, there are a bunch of places where the crowd can really contribute. And so now you have access to your best fans. You can see who contributes the most and the best, but you can also see who's holding the most NFTs, right? Sometimes that's a filter for who your biggest fans are or who has the most faith in you. And then you can start to, pull useful help, suggestions, brainstorming, contribution, work, right? You can start to pull that out of your crowd. And I think that is an amazing opportunity on top of just the fundraising.
Right. And so I think what Mike wanted to kind of build on what Mike is saying, because he's bang on. I was literally just going to talk about a DAO. And instead of using the analogy of, say, getting into the VIP room, you have more votes. So the more NFTs you own, you would have more votes, in the DAO, for example, because you have more exposure, you have more risk, people are going to hear you because you've put your money, so to speak, where your mouth is in that regard. But I really love what you're talking about in terms of how effective this is for businesses, how now you're leveraging your community to eat up a lot of what would be the big financial lift or the burn that a lot of companies are burdened with, say with like payroll or administrative help, legal, accounting. You can literally go into the community and essentially ask these people to help with some of this lift and monitor it, measure it, really bootstrap your business. And this is why the term, decentralized in this case would remove that word and just kind of say add efficiencies would be another way to look at it. And that's what I totally agree with you. I think that's the most powerful thing that for me that I'm taking out of this conversation with you today is really that, ultimately, I guess to really simplify it is that NFTs, there's a lot more to NFTs than I think the average guerrilla art, 2D guerrilla art meme suggests. And people are talking about it for good reason, because it solves a lot of problems for people.
I believe it does, and I believe it opens up a lot of opportunities. And it's a forcing function around community, which I think is great for businesses, right? Like if you want to be successful, you're going to need a community.
Right. Yeah, totally. I mean, I feel like we're just getting going, and we're going to probably wrap up the conversation up for now, but I think we're probably going to get you back to talk about some utility behind some of these NFTs, even as it enters into the financial industry, use case for peer-to-peer or decentralized autonomous organizations, insurance, and really what the actual kind of real world utility is for a lot of the things that Mike is speaking about. Thank you so much for being here. I know Bob had to dip out a little bit early. He literally had his 4-month-old real world. We're talking about real world assets and real world problems here. So I don't think there was an NFT to go and deal with his son. Probably, I don't think they're that advanced yet. Appreciate you being here.
Yeah, this was great.
This concludes another episode of the Founders Forum. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the hosts and for previous episodes, visit foundersforum.io. Thanks for listening.